All right, and we are going to start off with a quick little tax brain teaser. So, yeah, what better way to start a presentation than a pop quiz? So we have Mr. Bill, who is entering into retirement. Bill is now 65 years old. He has taxable income of $48,988. Of course, for this brain teaser, they would not use round numbers. But his top dollar earnings, as you can see, for a single filer, most of his dollars would touch the 12% bracket, and a few would touch the 22% bracket. That 48,988 taxable income includes 40,000 in IRA income plus 37,500 in Social Security benefits. So you can see his total income is a bit more than his total taxable income. We'll talk about that in a second. He decides to draw an additional $1,000 from his IRA for the 2024 year. So instead of just getting the regular 40,000 that he's getting for income plus the 37,500, he takes out an $1,000 distribution for a concert road trip. So the question, pop quiz, is how much will he owe in taxes on that extra $1,000? So remember, we said most of those top dollars that he earned may be taxed at that 22% federal rate. So if he pays 22 cents in federal income taxes for every additional dollar, therefore, if he took $1,000, he should owe $220. Well, if you guess that, then you're wrong, even though the math was mathing. Unfortunately, he owes $407 in tax, which is a 40.7% tax rate on that income. So as you can see, that's the conundrum of our tax code. My name is Marcus Rather. I'm a financial advisor here for Cetera Investors located in Glen Allen, which is in Short Pump area, Virginia, working with my clients throughout the state, or also some who are in different states. And what I will preface is that this presentation is focusing on taxes from a federal level. Please understand that state taxes will be different depending on the state that you reside and where you earn your income, actually. So depending on the state in which you're earning your income and where you live, state taxes may operate a bit differently. So I do encourage you to seek professional tax guidance on certain areas of taxes or specific tax questions. As we're going to be talking about a lot of different asset locations, where you may be talking about things that are pre-tax or tax deferred. So whether that's traditional IRAs, 401ks, 403bs, 457s, thrift savings plan, profit sharing, all the different types of employer-sponsored or self-employed type retirement accounts. If money has been deferred until later, then that is a tax-deferred type of account, in which when you take money out, you must pay taxes on distributions or on conversions at the ordinary federal and state tax rate. Now, if you're someone who's participating in Roth accounts, whether that's a Roth IRA or if it's a Roth employer plan like a Roth 401k or all those other types of plans that I aforementioned, you're contributing money on an after-tax basis, meaning the money grows tax-free, which is truthfully similar to a growing tax-deferred, but the difference is a tax treatment when you take money out of a Roth account. That money generally is withdrawn tax-free. There are some stipulations. Two of the major stipulations are typically you have to at least be age 59 and a half and have owned the account for at least 5 years. But if you meet those two criteria, then things that are in a Roth type of account will be withdrawn tax-free. Now, again, keep in mind, state taxes may be different, whether you're residing in the state of Virginia, New York, or any other state along those lines. Please be familiar with the state tax implication on money that's withdrawn or earned in interest, dividends, so on and so forth. So we live in a complex world, especially when it comes to taxes, right? So for one, what I will parenthetically note, although it doesn't speak it in this presentation, I think this is a perfect presentation to address, especially this year, reflecting back when Donald Trump was our president. He passed the Tax Cuts and Jobs Act, which created great opportunities, and it did change a lot of things in our tax code, whether it be beneficial or maybe not as beneficial or detrimental to you individually. It did have a lot of overhaul and tax changes that we're still experiencing today. And the reason I say that is because a lot of the personal tax rate changes, whether it was the percentages or if it were things that you can and can no longer deduct, if it were the exemptions, the standard deduction, or one major thing, which was the estate tax implications, the exemption on the estate taxes. A lot of those things are due to sunset in 2026. So from 2017, when it passed, up until about 2025 is where we're currently existing in our current, what we know as our tax landscape. But should there be no change or no reversion back, then we will see another change come 2026, where we could either revert back to our old tax law and tax policy, where rates are a little bit higher. We have personal exemptions again. You may be able to write off certain things that you may not have been able to write off in the past, or we could see another change, or maybe we see an extension. I don't perfectly know. I don't have a crystal ball. I can't even tell you what all it will come to pass, but I can say that there is going to be a change in the coming years. And I think this is a perfect opportunity to take a look at how taxes will change, whether it's the tax law or living in retirement, and how that will impact you living throughout your life. So there's a difference in the accumulation phase, where you were just simply setting money aside for the future and taking a strategic look at where you're locating those assets, versus taking money in retirement and distributing money, which is spending versus saving. Most retirees, they no longer get to enjoy the benefits of child tax credit or exemptions from personal exemptions and claiming more dependents. Mortgage interest deductions not only have the standard deduction doubled, so most people do not itemize their expenses. But if you're someone entering into retirement where you're paying off the mortgage, or maybe you're paid so much on the mortgage that there's not a lot of interest for you to write off, that may be a lost benefit from a tax standpoint. Tax-free employer-paid medical insurance, contributions to 401ks, a lot of things change as you transition from the accumulation phase to the distribution phase in retirement. And some things that are new, right? Social Security is a new source of income altogether. And please don't be shocked, as my father was. I unfortunately laugh at his demise, but my father learned that Social Security is taxable income. Up to 85% of Social Security benefits can be taxed on a federal level. Depending on the state in which you reside, it can also be taxed on the state level as well. We'll be talking about that in a few slides. But Social Security is a new source of income. Required minimum distributions will be a new requirement depending on the age in which you reach. Paying for Medicare is a new expense, right? Instead of you paying for health insurance or your employer offsetting some of those costs, you may be incurring the full cost of Medicare and supplemental premiums. And then the additional cost of long-term care, should you see that. So living life in retirement is a new and complex world. So a question that you may be asking is, so what's the first thing that you need to understand about retirement and taxes? And then through our conversation, we're going to be identifying 4 different keys and a lot of different examples, but 4 different keys. And I'm going to be sure to summarize this all at the end. So key number 1, you have to know what your after-tax retirement savings picture looks like before your retirement. You want to know what your after-tax retirement savings picture looks like before retiring. And this is simply just a concept of what we call, again, asset location. You know, as financial advisors, you may hear us talk a lot about asset allocation, which discusses how you're positioning money to be invested and managed within risk. But oftentimes, I think we don't fully focus on asset location, which is just identifying where your monies are, right? Are they in traditional pre-tax accounts? Do you have supplemental assets like Roth accounts, or maybe you just have a total investable account, which may be taxable every year? But one thing you do want to know is if you do have pre-tax money that's going to come due later, the value that you see is not the value that you get to keep, unfortunately. So if you save $500,000 in your 401k or IRA, it's not really $500,000, because we know Uncle Sam is going to get his portion. And depending on how much you withdraw, your total taxable earnings, so on and so forth, it's going to also determine the tax rate. So you can see if you're married filing jointly, your $500,000 could be $325,000 if it's all tax, or most dollars are taxed at a 35% tax rate, or it could be a little bit less if you reach the top federal tax rate, which would be 37%. In addition, you will be required to withdraw required minimum distribution each year after you turn the age of 73 or 75. Now, if you're someone that's saying, hey, I thought the R&D age was 70 and a half, I've heard about 70 and a half for so long, what I will say is that in the passage of the Secure Act 2.0, they did extend the age at which people are required to begin making minimum distributions. For someone that was not 72 or turning 72 in 2022, a lot of twos, that age was extended to the age of 73. So if you are not at an age which you're currently required to take minimum distributions, your age may be 73, or if you were born 1960 or later, so that will put you at roughly about 64, 63 turning 64 this year. If you were 63 and turning 64 this year or younger, then your full required minimum distribution age would be the age of 75. So what's the impact of that, right? When we look at, again, in the accumulation phase, having time to allow that money to continue to grow. Well, previously, if it were 70 and a half, you could see taking distributions at an earlier rate. If you had a 0% tax rate, there's more money that you can withdraw over your retirement lifestyle. But the more money that you have to withdraw based on R&D and the applicable tax rate, you see less money is earned to your person if you were at a higher tax rate, being 32% on the illustration. So, okay, but at least I still have Social Security to supplement my income and Medicare to pay my health costs. Yeah, it's a stage type question or thought. Most of you might not be thinking that right now, but that's what we're going to discuss. So key number 2, Social Security and Medicare have their own tax traps, and you need to prepare for them, whether it happens early in retirement or much later in retirement. So right now we're going to talk about Social Security and taxes. Example number 1. So going back to the brain teaser, why was it 40.7%? And I know it's a bit far-fetched. The numbers don't quite add, or the concept doesn't quite add up. The numbers are math, right? But you see, before the concert trip, the IRA income that he earned was $40,000. That's how much he withdrew from his retirement account to supplement or to satisfy his lifestyle. Social Security benefits paid him $37,500. All of these are gross before tax numbers. So theoretically, you would say total income earned for that year, $77,500. Now, he's a single individual. And being single, he likely would have taken the standard deduction, bringing his adjusted gross income to $65,538, thus bringing down his taxable income to $48,988. So his income taxes on his taxable income, $5,830. That's what the concept would have looked like in a traditional regular filing. But since he took out more this year in IRA income, instead of $40,000, it was $41,000. Social Security benefits were still the same, but you see his adjusted gross income didn't just increase by $1,000. It actually increased by a little bit more. Taxable income, total taxable income was higher, and the income tax was higher as well. So looking at a deeper dive, again, focusing on that adjusted gross income. So by adding that additional $1,000 of actual income, it actually increased both his adjusted gross income and his taxable income by $1,850. Not just a flat $1,000, $1,850. That means for every dollar of income he actually received, he was being taxed on $1.85. Doesn't quite make sense. The reason being is because depending on the total amount of taxable income, a certain portion of your Social Security Social Security income is subject to federal taxes. Now, the threshold for that, unfortunately, we don't go into the numbers on the perfect scenario, but just understand that depending on what your total source or total income is, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. So before the concert trip, where it's saying that his total Social Security benefits, only 50% of his Social Security benefits were subject to federal taxes. But because he withdrew an additional $1,000 out of his IRA, more than what he was previously pulling, up to 85% of his Social Security income was subject to taxes. And that's where you see the extra $850 added to total taxable income, thus increasing his total income tax from that distribution. So again, the numbers here, you just see the effective marginal rate for the $407 difference in income tax. You take 407 divided by 1,000, that shows the effective marginal tax rate versus the stated marginal tax rate. Please understand with taxes, it's not to say that, the total taxable income that you see, 50,838 is all taxed at 22%. That's not quite how that works. Taxes are a progressive system. So the first taxable dollars up to 11,000 are taxed at 10%. The dollars that are earned from 11,601 to 47,150 are taxed at 12. And then the dollars earned from 47,151 up to 100,000 are taxed at 22%. So that's why the stated marginal tax rate that you see on the brackets are not your effective marginal tax rate. So Medicare and taxes. So we talked about Social Security. We identified that up to 85% of your earnings can be subject to federal taxes, depending on your total taxable income and your adjusted or modified adjusted gross income. Now we're going to talk about Medicare. So in this example, we have a married couple, George and Martha. George and Martha are on or receiving Medicare benefits, parts B and D for prescription drugs and doctor visits, as well as hospital stays, so on and so forth. So we're going to talk about this thing called IRMA. It's a income-related monthly adjustment amount. The emphasis is on income because it's a monthly tiered surcharge. It's kind of like a tax that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $103,000 for single filers, $206,000 for married couples filing a joint return. So in this example, they have Medicare's Part B and D. They have $322,200 in modified adjusted gross income in 2022. They sell a stock for a $1,000 gain. They would then owe $188 tax, which is $150 plus the $38. I believe that's a 3.8 surcharge for their earnings and a 15% long-term capital gains rate. But what does that have an impact on their Medicare Part B and D premium? Glad you asked. As you can see, what's circled for someone who's married filing jointly, their modified adjusted gross income was now $322,000 and more than that dollar. So where they were previously in the third tier, where the total monthly amount would have been $349.40, that stock gain that they recognized, even though the gain was taxed at capital gains rates, it was still added to their modified adjusted gross income, thus bumping them up into a higher penalized premium, now increasing their premiums from $349.40 per month per person to now $454.20 per person. So it not only had an impact on taxes, but that bumped them up into a higher tier to where they're paying extra for their Medicare Parts B and D premiums. So when you look at Part D, right, the same tier or the same thresholds apply. So previous slide, we were looking at Medicare Part B. Now we're looking at Medicare Part D for the prescription drugs. So George and Martha will each owe $20.05 per month on their drug plans, which is an extra $492 for the couple over the course of a year. So when we add that all up, right, when we look at Medicare Part B plus the IRMA adjustments for both George and Martha, the combined total would have been $3,007.20. So they sold the stock for a $1,000 gain. Stock sale had a tax of an 18.8 rate, which was 15% long-term capital gains, plus a 3.8% surcharge because of their total taxable earnings. The stock sale triggers a new IRMA, which bumps them into a higher income tier. So the total IRMA surcharge is now $3,007.20. So the 1,000 extra income triggers taxes of $3,195.20, which is a real tax rate of 319.5%, if that's how you choose to look at that percentage. Now, example number 3, since we just previously talked about IRMA and the impact on extra withdrawals, the example number 3 is going to be talking about late enrollment penalties. So previously, we were talking about the income that you earn, the taxable income, where your brackets or where the ranges will fall for Medicare Parts B and D. Now we're going to be talking about late enrollment penalties, which are a life-lasting penalty. At least with IRMA, depending on the income and how much you make, there is a chance that your IRMA can change or you can bump down a tier or two. So Jim and Ann, we have Jim and Ann who are both 68. Jim retired at 65, Ann retired 1 year later at 66. They got coverage through Ann's employer who offered retiree health insurance. The one question that they asked is, when should they enroll in Medicare Part B? So the suggestion is, of course, enroll in Part B as soon as you retire. But they did not know that they had to enroll in Medicare Part B as soon as Ann retired. So even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. So Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. So unfortunately, because they weren't able to start the coverage until the next year, they have a 10% of the base premium for Medicare Part B added to their monthly premium for their life. So you can see for 2024, if the monthly premium is $174.90, a 10% penalty is an additional $17.49. So over 12 months, that's $420 for the couple and added penalties added to their Medicare Part B premium. And premiums do tend to increase every year, so do the penalties. So if 174 turns to 175, the 10% is still the same 10%, but by a dollar value, it's a lot more. So it could translate to a lifetime of over $10,000 in the state. So you do want to watch for coverage gaps as you're looking to enroll in Medicare Parts B and D. Consult with myself, consult with a Medicare professional on what coverage is suitable for you in retirement and when's the best time to enroll in Medicare. So we talked about a lot, right? Social Security taxes and the tax trap that can be impacted there. Talked about Medicare, late enrollment penalties, and IRMA. What other tax traps could there be? So the third key, so the first key was knowing your after-tax assets and after-tax income. The second key was watching the tax traps from Social Security and Medicare. The third key is you must plan how and when you will use your taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. So previously we talked about asset location, identify where your tax-free assets are. Now we're going to be talking about strategically withdrawing from the right buckets or the right assets to manage your tax brackets efficiently. So in this example, what you would want to consider in this example is consider converting money from pre-tax assets to Roth. What you would do there is that you would essentially pay the taxes in the year that you convert or move money from a traditional account to a Roth account. You pay the taxes now and reap the benefits on the back end. So IRA or similar retirement funds are moved to a Roth IRA or a Roth type of account. The taxable amount converted is added to your income. So in this example, we have Jill, who converts $100,000 from her IRA to a Roth IRA. Now, what Jill is doing is she would have to add that $100,000 to her taxable income for the year. The conversion income will be taxed at Jill's ordinary income tax rate. Now, oftentimes, how this works in practicality is when she converts, she has the option of either withholding taxes from the converted amount. So say she's converting 100,000, we have a rough idea of the taxes that are going to be owed on 100,000 in earnings. maybe we just choose to withhold that money from the 100,000 that's being converted. Where that could benefit is that you're just withholding it, so there's less money out of pocket or that you find from somewhere else to pay that tax bill. Where it can cost is that that's less money that you would have in your after-tax money. So not only are we paying taxes on 100,000, but we're reducing that 100,000 by the amount that's withheld. So we're not really fully experiencing the tax-free money of 100,000. This theory that we're showing on the screen is filling up the bracket. So using Jill again as that example, maybe her earnings were touching the surface of the 22% federal tax bracket. And with that 100,000 conversion, that's enough to keep her in the 22% bracket without bumping her up into the next bracket, which would be 24%. So as you're looking at Roth conversions, one thing you want to consider is how to fill up the bracket as best as possible. How much can you convert and handle the tax responsibility for that conversion without bumping you into an entire higher bracket? So other possible approaches to managing tax brackets, you can always withdraw tax-free money from life insurance policies. For someone who has owned a life insurance policy for many years and has had some cash value accumulation, that now is an asset that you could possibly use as part of supplementing your retirement income or your needs in retirement. So maybe you look at life insurance as an asset as opposed to a protection resource. You could sell highly appreciated stock for low or no capital gains. That's what we call tax, gains harvesting or tax loss harvesting, identifying which stocks or which individual holdings to sell at a gain or a loss. Or you could take distributions from IRA or 401ks to take advantage of a lower tax rate. If you're someone who's entering into retirement and your retirement income is lower than your regular ordinary income, you may find that you may be in a lower bracket in retirement than what you were when you were working. So maybe taking distributions from those pre-tax accounts earlier rather than later could benefit you as well. Two other pre-retirement strategies, if you qualify. Funding a health savings account. Health savings accounts are what we call a triple tax-free benefit because the money can go in tax deferred. You can put money into a health savings account on a tax deferred basis or pre-tax basis. That money that's in an HSA can be invested. The growth that you see from the money grows without being taxed. So there's tax deferral. And then if it's a qualified medical expense, which I don't believe premiums do apply. But if you're paying for medications, if you're paying for doctor visits, if you're meeting a deductible or co-insurance, those are qualified medical expenses. Money that's withdrawn from a health savings account for those eligible expenses are tax-free. So there's a 3 times tax benefit on money that's positioned efficiently in a health savings account. You can also use a qualified business income deduction after funding a company pension. For all self-employed individuals who may be joining us today, 20% of your revenue is 20% is dismissed, if you will, from your revenue as a qualified business income deduction. That also is subject to change with the key Tax Cuts and Jobs Act. So now these few years that are left, this may be a huge benefit to recognize and possibly use some of your revenue or some of your assets to fund a company pension or your own type of retirement account. So in this example, charitable giving and tax planning, we have Albert and Shirley who jointly or combined, their top dollars are taxed in the 24% bracket. Every year they give $5,000 to charity. $15,000 is in existing itemized deductions. With the $5,000 charitable donation that they make, because the 2024 standard deduction is $32,300, the donation that they make to charity, they don't recognize as an itemized deduction. So since they're taking the standard deduction, they won't enjoy the benefits of seeing or recognizing the itemized expense, which is their charitable contribution. So that brings up one tax savvy strategy, which is qualified charitable distribution. So while I previously mentioned that the required minimum distribution age did extend from the age of 70 and a half to 72, or 73 or 75 if you're currently not making any distributions. One thing that did not change with the 70 and a half age is the ability to take a qualified charitable distribution. So for the 2024 tax year, you can take up to 100,000 from an IRA per person in the form of a qualified charitable distribution. When you're making a qualified charitable distribution, the funds must go directly to the charity, and it does count as a required minimum distribution, but it's not reported as income. And there is no deduction on your income taxes because the income is not, or the distribution is not counted as income. So option one, let's see this play out in practicality. The charity gets $5,000 from the family. The $5,000 was given out of pocket to the charity. $5,000 satisfies the required minimum distribution because it came from the IRA to the checking account of the family, and then the family gave the $5,000. Because the money came from the IRA and was paid to the family, the $5,000 is reported as taxable income. That $5,000 in taxable income at the 24% tax bracket equals $1,200. Probably some more tax traps in there, but for this example, we're going to keep it easy. So the total cost of the charitable contribution wasn't just $5,000. It was actually $6,200. The $5,000 that they gave and withdrew from the IRA, and then the $1,200 tax liability. But in this option two, say they did the same thing just in a different way. So say they exercised a qualified charitable distribution in which the $5,000 that they withdraw from the IRA goes directly to the charity. Now, because it goes directly to the charity, the $5,000 is still being withdrawn from the IRA. So it checks off the box for the required minimum distribution. Because it goes directly to the charity, the $5,000 is now excluded from their taxable income. So the tax bill on the distribution equals $0. The total cost of the charitable contribution is just the $5,000. Also, remember the added benefit here. Because they're taking a standard deduction where they generally would not be able to itemize their expenses and recognize that $5,000 as a charitable contribution, here they're actually able to receive the $5,000 full benefit because they satisfy the R&D, they don't pay taxes on the money that comes from the IRA, and they still give to the charity of their choice. So you may be thinking, I hope to have assets to pass on to my family. Maybe you're not so much concerned on charitable contributions. Maybe you're focused on leaving that financial legacy to your family. So the question that you may ask is, how does retirement tax planning figure into leaving assets for your family? Which brings us to key number 4. You want to organize your assets from your family's benefit. Estate planning still matters. So as we talk about taxes and long-term care, one of the larger expenses that people will have in retirement is that cost of healthcare. While in cost of healthcare, generally we're speaking on premiums, deductions, co-insurances, co-pays, so on and so forth. Long-term care is a significant expense that many retirees may face in retirement. In fact, there's probably a 60 or 70% chance that one person out of a married couple may experience the need for long-term care. So premiums may be deductible at federal and state levels. The payments from policies for reimbursement on long-term care expenses are tax-free. And choosing how to pay for long-term care costs can have a big impact on heirs because, again, that's money that's being directed for the benefit of the care of the individual, which is a great thing. I don't think anybody's going to argue about that. But with that added expense, that may be taking money away that could be potentially left over to the surviving spouse or surviving family members. So in this example, we have Miss Florence, who is a widow. She has unfortunately outlived her spouse, or fortunately, but unfortunately, experienced the loss of her spouse. Miss Florence qualifies for long-term care benefits. She receives in-home care benefits, which cost $60,000 per year for in-home, so at least she's able to stay home. She receives $20,000 a year in Social Security, She's she has 400,000 in IRA assets as an IRA balance, but she also has protection. So this protection that she has is a life insurance policy with a $500,000 death benefit. But not only is it just a standard death benefit, there's an additional long-term care rider that will provide resources or funds to offset her cost for long-term care. So those benefits, she's able to earn up to $10,000 per month for her long-term care costs up until she exhausts those benefits. So just to go back over that again, $60,000 a year long-term care expenses. She has $20,000 a year in Social Security benefits, meaning she's likely supplementing that with money that she has set aside, i.e. the $400,000 in her IRA. And she has a life insurance policy that has a $500,000 death benefit that can provide up to $10,000 for long-term care costs. Now, I parenthetically note, this is a wonderful example of why life insurance still matters in retirement. Maybe not so much simply of leaving the legacy, but providing added liquidity and extra resources. So much so that it's more than just paying final expenses, or maybe you're not too concerned about leaving the legacy. But this is just another reason of where life insurance can make sense in your elder years, more than just paying final expenses. So we're going to have two different scenarios here. Fortunately, two different scenarios. So the first scenario is that Florence traditionally uses her long-term care policy to pay for 5 years of care. So she had the life insurance policy, she had the long-term care rider, she used the long-term care rider for the long-term care. Nothing's wrong with that, right? So she pays little to no income tax during the 5 years because she's using the benefit from the life insurance, which is a tax-free benefit. Her long-term care insurance pays $300,000 for in-home care, which is $60,000 per year over 5 years. When she passes, the kids will inherit a tax-free life insurance of $200,000, so it's less the benefits that she used, as well as the $400,000 in her taxable IRA. And we're just assuming the IRA wasn't spent down, depleted, or it didn't change in value. Nothing's wrong with that, right? $200,000 tax-free, $400,000 in taxable IRA funds, left a legacy of $600,000, some tax-free, some taxable. Scenario number two, however, so this is where we're talking about flexibility, leverage. Now we're saying she uses the IRA to pay for care. So instead of using the natural design life insurance policy for long-term care, she's going to use the assets for long-term care. So she's going to pay little to no income tax during the last 5 years, partly because one of your itemized expenses is medical expenses. It's $60,000 worth of long-term care is a medical expense. And you have to think over a certain percentage of medical expenses, I believe at 7.5% of your adjusted gross income, everything past 7.5% can be deducted as an itemized expense. So the money that she's withdrawing from her IRA used for medical expenses actually is a tax benefit to her. She used the IRA money to pay $300,000 for her in-home care, same dollar amount as scenario one. But when she passes, she leaves $500,000 tax-free to her family, and $100,000 is left in remaining IRA funds. In both of these scenarios, right, $600,000 are left to the family. In one scenario, $200,000 is left tax-free, $400,000 is left taxable at whatever the children's taxable rates are. Scenario two, $500,000 is left tax-free, $100,000 is left taxable. So we compare the cost. You can use $300,000 in taxable money versus $300,000 in tax-free money, but the assets that are left after are what you may want to consider. So you may be thinking, goodness, how in the world will we ever manage this? There's a lot of different keys, right? So taxes and retirement highlights, if you're pre-retirement, if you have yet to retire and you're still identifying those asset locations, what you want to know is your after-tax savings before you retire. Identify what will be tax deferred, what's going to be taxable, and what's going to be tax-free. If you still have time, it is encouraged to fund Roth accounts. Generally, it's better for someone who has many years to allow that money to grow. But in any opportunity, funding Roth accounts can make sense. If you're someone who's in early retirement, you may want to take a look and see or understand your Social Security and Medicare taxation, whether simply how much of your Social Security income is subject to federal taxes, or how close are you to having any surcharge or income related adjustment amount on your Medicare Parts B and D premium. You also want to fill the tax brackets in low income years. So if you've entered in retirement and you're making less and that's subject, you're taxed less on your income, maybe these are the years to benefit from Roth conversion. Not just because you're making less, but also as I identified, tax rates are lower than what they were in 2017 and years prior. And as these rates begin to sunset in 2025, maybe this year and next year are the last 2 years to recognize lower tax rates before we have a raise on all federal tax rates. So maybe these are the years to identify Roth conversion. If you're in the middle of retirement, you do want to manage your plan required minimum distribution. Maybe exercising a qualified charitable distribution makes sense. If you're someone who's regularly tithing and offering or giving to a charity of your choice, with drawing required minimum distribution, maybe it's just a simple accounting fix where you just exercise a qualified charitable distribution to satisfy your required minimum distribution and still satisfy your contributions to your charity. And what I will say is just because you don't have to donate your full required minimum distribution, you can take a qualified charitable distribution in any amount up to $100,000 per individual per IRA. If you're in late retirement, you want to organize your assets for tax efficiency and estate planning. Identify what are the more tax efficient ways of leaving that legacy for the next generation. Is it the life insurance policy? Should we increase life insurance? Should we plan on how to withdraw the money in retirement? So the solution, because your tax exposure will change throughout retirement, you need a tax strategy that anticipates how and when you tap assets to cover your personal expenses, that understands the range of taxes you will face at various stages, and manages your actions so that you pay lower tax rates. So preparing for retirement and taxes, again, there's a difference between the accumulation phase and the distribution phase. Mistakes can be costly. So essentially we're saying, identify, work with your financial professional, allow your financial professional to work with your tax professional to identify the most tax efficient strategy for you to sustain a comfortable standard of living. So I've been checking the Q&A. I haven't seen any questions, but now that we're towards the end of the presentation, please filter all questions through that Q&A feature on your Zoom. If I don't get any questions, I just want to assume I did a great job and you guys were fully attentive, which I love. So thank you so much for sticking with me through this very complex conversation. And yeah, so no questions so far. So I'm gonna go ahead and stop the recording. I thank you so much for joining our experience this evening. What you can expect is to receive a